Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is February 10th, 2025, and we're diving into Hain Celestial's fiscal second quarter 2025 earnings report. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Hain Celestial, a leader in the health and wellness sector, has just released their Q2 2025 earnings. Despite some challenges, they are making strategic moves to position themselves for growth in the latter half of the year.
Revenue and profitability overview. Let's start with the top line. Hain Celestial reported net sales of $411 million for Q2 2025, a 9% decrease year over year. John, can you elaborate on the factors affecting their revenue?
Certainly. The decline in net sales was primarily due to poor in-store performance in the snacks category and supply chain challenges. However, they did see sequential improvements in their baby and kids and meal prep categories. The gross profit margin increased slightly to 22.7%, indicating some operational efficiencies despite the sales drop.
And what about their earnings per share?
Hain Celestial reported an adjusted EPS of 8 cents, which fell short of the forecasted 12s by analysts. This shortfall is attributed to the challenges in marketing and supply chain, which they are actively addressing.
Cash flow and debt management. Despite the earnings miss, Hain Celestial has shown strong cash flow performance. Can you tell us more about this, John?
Absolutely. The company generated $31 million in operating cash flow, up from $21 million in the previous year. Free cash flow also improved to $25 million. They've been effective in reducing their total debt to $729 million, which is a positive sign of financial discipline.
How does this impact their financial health?
Reducing debt and improving cash flow strengthens their balance sheet, providing more flexibility to invest in growth initiatives and manage any unforeseen challenges.
Strategic initiatives and future outlook. Hain Celestial is exploring strategic options for its personal care category. What does this mean for the company, John?
They're looking to streamline their portfolio by potentially divesting the personal care segment. This aligns with their strategy to focus on better-for-you food and beverages, which could enhance long-term shareholder value.
And what about their future outlook?
They've revised their guidance, expecting organic net sales to decline by 2 to 4% and adjusted EBITDA to remain flat year over year. However, they anticipate improvements in gross margin and free cash flow, which are encouraging signs for the second half of the fiscal year.
CEO and CFO statements. Let's discuss the leadership's perspective. What did the CEO and CFO have to say about these results?
Wendy Davidson, the CEO, expressed confidence in the actions taken to address the challenges, emphasizing the potential for organic net sales growth in the second half. CFO Lee Boyce highlighted the need for disciplined execution and mentioned recent distribution wins and the recovery of their infant formula supply as positive developments.
It seems like they are optimistic about the future despite the current hurdles.
Indeed, they are taking proactive steps to navigate the challenges and are focused on leveraging their strengths to drive future growth.
Key takeaways. In summary, Hain Celestial faced some challenges this quarter, but is making strategic moves to position itself for future growth. John, any final thoughts on their investment prospects?
While the short-term outlook is cautious, their focus on core categories and financial discipline could yield positive results in the long run. Investors should keep an eye on their strategic initiatives and market conditions.
Thank you, John, for your insights. And thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Hain Celestial's performance in the comments below.